Okay. Good afternoon to everybody on the East Coast. Good morning to those who are dialing in from the West Coast. Looks like we have a number of attendees still dialing in, so I'll give it another 30 seconds or so before we kick off the presentation. Okay, I see a bunch of familiar faces and names coming in, so another 5 or so seconds, and then I'll kick this off. Okay, we still have a few more, but let's go ahead and get started in the interest of time. For those that don't know me or haven't had any communication with me, my name is Chris Reese. I am the CEO and founder of MJ REIT. Just a quick background on myself. I've been in the asset management space for about 30 years now, 15 of those on the public side and the last 14 on the private side. And I made that transition because going all the way back to 1999 and 2000, when at Vanguard, I thought we built a number of very well diversified portfolios. But when the tech crash hit, what I noticed was the diversification went out the window when there were global market crisis. And with that, correlations went to one, and the diversification that we thought we built really just did not hold up in investors' portfolios. So I transitioned to the private side in 2009 with a firm and launched the first private business development company. And in 2022, ventured out to start MJ REIT as a way really to provide investors with a dual mandate. And the first is price stability, and you'll see that throughout the presentation today. And the second is above market income. And so we have consistently, and we just completed in May our 33rd month of performance. We've exceeded our 10% annualized distribution target every one of those months since inception. So very proud of the team for not only the deals that we've put into the portfolio, but also for the track record that we've been continuing to create for our investors over time. So with that, let me go ahead and jump into the presentation today. Just a quick disclaimer in the upfront. So this presentation is not an offer or an opportunity to buy or sell securities. That offer is made only through the PPM. Consult a financial advisor before allocating. And of course, past performance is not a guarantee or indicative of future results. So I wanted to take a quick second in the opening slides and just understand who we are. So if this is your first time hearing our presentation, we are an institutional real estate lender at heart. We manage a debt fund and we're providing capital to a capital-starved industry. And I'll talk a little bit more about that. And we're very much focused on risk mitigation and operating in an investor-friendly strategy. And the investor-friendly strategy, I mean by that is we have monthly purchases, monthly redemptions, monthly valuations, monthly distributions, and we are 1099 tax reporting. So no worries about waiting for a K-1 in August or September and having to delay filing of your taxes. I want everything, and when I design the strategy, to be extremely investor friendly. And then from a performance standpoint, we target, as I mentioned, that double-digit monthly income. Since inception, the total return of the portfolio stands at 11.29%, and that is net of fees and all expenses. And I want to make a statement on the upfront, and I'll circle back to why this makes sense as we go through the presentation today. But we don't touch the plant. And what does that really mean? In the strategy overall, I discovered back in 2022 an opportunity to provide capital to the cannabis industry, but focused solely on hard assets and real estate being the crown jewel of those assets. But important to me, I didn't want to lend directly to an operator, but rather lend on a piece of real estate. So we're not lending or quote unquote touching the plant. We're simply providing financing on a piece of commercial real estate. And the reason for that is that banks simply won't lend to the industry. And I'm going to circle back on that point several times throughout today's presentation. So there's four objectives that we're looking to cover today in the next 35 or 40 minutes. And the first, we'll start out on a basic aspect of why one should consider alternative investments for their portfolio. We'll transition then to the second objective, how private real estate can help with that diversification. We'll look at and transition to the opportunity within specialty real estate. And then finally, we'll close out with how MJ REIT may be suitable for an allocation within your broader diversified portfolio. So when I always have a conversation with investors when I start out, just to level set the importance of getting away solely from the public markets and transitioning, or at least considering allocating to a private asset. So I took a look in the pie chart on the left-hand side. I look at all of the companies in the United States that are private versus public. But importantly, I weeded out all of the small mom and pop shops that might be a coffee shop earning a couple $100,000 a year. But rather, I focused on companies with annual revenues in excess of $100 million. And if you were to look at those companies, 86% of those companies are private and 14% of those are public. Said differently, if you only have exposure to public stocks and public bonds, you're swimming in that 14%, or you're missing the other 86% of the opportunity. And so by generally allocating to and selecting private assets, you'll gain exposure outside of the public markets, and that can help with a number of different characteristics, which we'll review in a second. When I generally tell individuals this statistic, a lot of the pushback I get is, what about like even bigger companies? And so on the chart on the right-hand side, towards the bottom, I broke out companies with annual revenues of 1 billion or greater. And even in that segment, if you look on the bottom, 11% of those are private versus only 7% being public. So this holds true not only on the smaller or small to mid-sized companies, but also holds true on the large mega cap companies as well. So how can alternative investments help? First, they can help diversify your portfolio because they can offer lower correlations to the publicly traded markets. They can dampen the volatility. So when you get the recent volatility that we've seen in the market, our portfolio has remained stable and our investors saw no volatility during these volatile markets. And then lastly, private investments or alternative investments have the ability to enhance one's return in a broader diversified portfolio. So I always take a step back and look at how the ultra wealthy invest. And we've all heard a lot about this notion of a 60-40 stock and bond portfolio as one that provides enough diversification for your typical investor. So I took a page out of what I'll refer to as the ultra wealthy. There's a group called Tiger 21. You have to have a $50 million liquid net worth to be included in membership. And once a quarter, they produce a quarterly member allocation report. So this is as of the first quarter of 2025. And what stands out to me is if you look at the exposure that is to public markets, the stock market and fixed income, the combination of the two is just about 30%. And if you look at their allocation to alternatives, and that would include private equity, private real estate, hedge funds, commodities, currencies, that takes you up to almost 60%. So the ultra wealthy have understood and they allocate to a much greater degree than you or I may to private investments. Well, why is that? They understand the benefit, the reduction of volatility, and the potential for return enhancement. Not that this is right or wrong, but we take a page from how the ultra wealthy and even smaller institutions are allocating within their own portfolios. So what's the opportunity in real estate? And this is one that I want to provide a 30,000-foot view because for those that don't have exposure already to real estate is a very large asset class. So the three largest asset classes in the United States are fixed income, real estate, and stocks or equities, with fixed income being the largest at just over $54 trillion. You look at stocks almost at 50 and commercial real estate at $24 trillion. But unlike fixed income, which is income oriented, or stocks and equities, which are more growth oriented, real estate can have the ability to provide not only the income from monthly rents, but also the appreciation associated with property going up in value over time. So for us, it's a no-brainer that real estate combines the best of both fixed income on the income side and then stocks for the growth side. And similar to what I just outlined in the private companies in the earlier slide, generally private markets are the way or primary way that investors gain exposure to this asset class. So if you're to look at the entire commercial real estate market, only 6% of that is held in publicly traded REITs. The rest is owned through private investors on the private real estate side. On the right-hand side, I show the allocation that your typical investor versus some institutional clients have to private commercial real estate. Public pensions, endowments have 10 or even 12% exposure, but the typical high net worth investor has less than 3% of his or her portfolio allocated to private commercial real estate. And we believe that there's an opportunity to increase that over time for investors, but do so in a way that doesn't trap you into making an investment where you'll have zero liquidity for the next 10 or 15 years waiting for that asset to play out. Real estate has also been a tremendous hedge against inflation. We've heard over the last few years that the Fed is trying to get inflation under control, trying to get inflation to that 2% target. But generally speaking, real estate has been a tremendous hedge against that inflation because as you see the creep up in inflation, rents can also be raised and you typically get an appreciation in the value of the underlying asset. So real estate has outpaced inflation over time. And real estate has also been consistent with its income that's been distributed. So it's somewhat of a confusing chart, but what I did is I looked at the last 20 years and highlighted the annual distribution of private commercial real estate. So over the last 16 years, over the last 20, 16 of those years, there was a distribution, an annual distribution in excess of 4% or greater. Three of those years had 6+%. 4 years had distributions of 3 to 4%, but importantly, there were 0 years where the income on an annual basis was less than 3%. And these aren't staggering numbers at 3 or 4 or 5 or even 6% to you and I, but in the specialty real estate sector, which we're going to spend some time on today, that number can be significantly higher. In fact, and as I mentioned earlier, MJ REIT, we focus on a 10% annualized distribution. And every month since inception, we've exceeded that target for our investors. On the low side at 10.2% annualized and at the high side, 16.67. So we check that box on above market income for our investors. So let's talk about specialty real estate and the opportunity that we see within this area. But before we do that, I want to take a second just to define for those that aren't aware of what specialty real estate really is. You can think of it really as the real estate outside of your traditional multifamily value add or even residential and focus more on these niche areas of the market like historical buildings, maybe luxury, ultra luxury houses, parking garages, agricultural farms, movie theaters. And then on the top left, I highlight this niche area where we focus on, which is in the cannabis real estate sector. We truly believe that given the dynamics of the market today, this is an opportunity to earn outsized risk-adjusted returns on a monthly basis. So the opportunity as we see it within the cannabis market really can be categorized in three buckets. The first, looking at strong growth characteristics. Cannabis remains one of the fastest growing segments of the US economy. It's doing so without access to traditional lending sources like commercial banks. So if you have a warehouse and a cannabis tenant, you can't go to Wells Fargo, JP Morgan, or any other bank to get a mortgage on that property because banks won't touch it given the association with cannabis. And lastly is the limited institutional involvement within the cannabis real estate sector. And that institutional involvement, while be it low today, it will come in over time. And as with any sector, when you have a large influx of capital into the market, that will generally lift all asset prices higher. So in summary, you have high growth, you have a lack of capital to fund that growth, and you have a limited institutional market to continue to prop those assets higher. So when we look at the cannabis space and we have these three characteristics, we look at this as a fantastic opportunity to earn better risk-adjusted returns for investors. And this is probably one of the most important slides specific to the macro environment within the cannabis space. So if you look at the chart on the left, back in 1996, the revolution began with Proposition 215 in the state of California, at which point California legalized medical marijuana. 4 years later, in the year 2000, you had the entire Western Seaboard, along with Colorado and Alaska, which I guess it can be considered on the Western Seaboard, all having a medical program. If you roll 10 years forward to the year 2010, and that's in the middle chart, you'll see the continuation of more states moving to a medical program, and then even some states popping up on the East Coast, also embracing that medical program. Fast forward to today in the year 2025, the chart on the right-hand side, vast majority of states have a medical program. Many of those states also offer what I'll use interchangeably the term adult use or recreational cannabis. So out of the states today, we have 41 states that have at least a medical program, DC, and 3 US territories. But importantly, and this creates the barrier to entry. So when a state goes in from zero to medical and medical to recreational, that increases the total addressable market and increases the demand for the product. But you can't cross state lines with cannabis because it's still federally illegal. So that excludes or precludes Philip Morris from coming in and buying 500,000 acres in the state of Utah or New Mexico and growing cannabis and then shipping that all over the country. So every state that has a medical or recreational program needs to have its own real estate for growing. It needs to have its own real estate for processing, and it needs to have its own real estate for dispensaries to sell those to the end users or consumers. That's where MJ REIT gets involved. We deal solely on the real estate side, and we don't lend directly to the operators. And you may question, why are these states even continuing to take on these programs? If you're the governor, let's take the state of Pennsylvania, for example. If you're Governor Shapiro and you're looking at the state of Pennsylvania, medical cannabis is legal today in the state of Pennsylvania, but recreational is not. So if I live in Philadelphia, I can go across the bridge to New Jersey. If I live in the north, I can go up to New York. If I'm on the western part of the state, I go to Ohio. South, I can go over to Maryland. And in fact, 5 of the 6 bordering states have a recreational program. So if I go over to one of those states and buy cannabis, guess who collects that tax revenue? It's not the state of Pennsylvania. So the bordering states collect this revenue and Pennsylvania does not. So the point is, as states continue to legalize and move ultimately to a recreational or adult use program, their ability to raise tax revenue and fund the budget deficits increase. So just follow the dollars. And more states will continue to come online, where you have Kansas most likely to have some sort of legislation as we go through 25 and into 26. Pennsylvania is hopeful to move to a recreational program that will start by early 2026. And Florida, although was turned down in the last election, there is a big push to legalize recreational cannabis in the state of Florida. So a lot of capital has been raised within this space, and a lot of returns have been generated for investors, but you have to do so with risk in mind. And that's what we tend to focus on, is that risk mitigation within MJ REIT. To put the numbers into perspective, if you look at 2024, the total sales of cannabis exceeded $32 billion. It's estimated that sales in cannabis on the legal market will exceed 35 billion in 2025 and close to 70 billion by the year 2031. Additionally, if you were to include sales in the illicit market or illegal market, sales in 2025 will exceed $100 billion. That puts this industry on par with tobacco, alcohol, and wine. So it's a very sizable industry, and it's not going back. If anything, it's going to continue to expand. But if you look at the broader economic impact, and the impact being measured by, you work at a cannabis dispensary, you earn a salary, you take that salary, you invest it into the community through your rent, buying groceries, gasoline, automobile insurance, buying a car. That has an additional impact to the overall economy, where this year alone, it's expected to come close to $124 billion. So this is an enormous industry. It's continuing to grow, and MJ REIT is positioned well to take advantage of this growth. The point with banks and banks not lending into the space, I tried to put it into an illustration on the left-hand side of the chart. So in the United States today, we have a little less than 4,500 banks. Out of those, you have roughly 15 or so percent accepting deposits. So that means if you're own a dispensary, you're doing transactions, you have a bunch of cash and you want to put that in the bank, there's about 800 plus banks that will accept that cash so you can deposit it and not just have to put it in a safe in your basement. But out of that, Interestingly, those banks generally don't pay any interest. And in fact, some charge a negative interest rate, meaning that you have to actually pay the bank, given the heightened compliance around banking in this space, that you're earning a negative interest, paying money just to keep your money at the bank. But the point I want to make on this slide is if you look at that number less than 50, so you have all these banks, but the number of banks less than 1% are actually making loans to the cannabis space. And therein lies this secret to what we do. We fill this void within the cannabis space. And because there's such high growth and such limited amount of capital, we can charge more for the money that we're lending to. We can be very selective in the deals that we fund and ultimately generate better risk-adjusted returns for our investors. The chart on the right-hand side, to the point of the lack of institutional ownership, I thought a good comparison would be to look at the top five tobacco and alcohol stocks. And out of those stocks, look at the percent of which is owned by institutional investors. And it's just south of 80% of the shares of the outstanding companies are owned by institutional investors. But if you look at the smaller column on the right-hand side, I looked at the top five cannabis MSOs, and MSOs to stand for multi-state operators, meaning they have a location in multiple states. The top five cannabis MSOs, the institutional ownership was about 7%. So there's not a lot of institutional demand at this point, but that will change over time as regulations continue to open up and more capital comes into the market. So how do we capture this opportunity? And this is the point where really I want to spend some time on MJ REIT and our ability to generate returns consistently for investors over time. I won't go through this slide too much with our investment strategy statement and value proposition, but fundamentally, I'll say this. We originate debt and equity transactions, focusing solely on the real estate side within the broader cannabis sector. And I'm going to come back to this point, which is critical to what we use or what we do. We use an alternative use valuation when we come up with the value of the property to which we will lend against. And I'm going to make sense of this in just a second, so hang in there. And then our value proposition, we're really focused on price stability and above market monthly return for our investors. So similar to the chart I showed on the equities, fixed income, and real estate, MJ REIT blends the best of both worlds because not only are we primarily focused on lending or originating transactions in the private real estate side, in times of market dislocation, we do have the ability to allocate to a smaller degree, but still can be very impactful to the fund on the public security side. So you get the main exposure, which is the exposure to the private market, but we have the ability also to allocate a small part of the overall portfolio to the public securities within the broader stock and bond market. Getting back to the point that we really focus on a 10% annualized distribution, which I've mentioned already. And I thought this chart was helpful because what I've done is I've looked at the opportunity, or I should say the ability for us to continue to pay those distributions. The big chart in the center towards the right-hand side, we look at the monthly distributions every month since inception. Our goal is at 10%. And as I noted, we've been above that goal every month since inception. In 3 months, which I'll highlight in another slide or two, where our distribution spiked to over 15% during those 3 months. Because we're taxed as a REIT, anytime that we have a property that pays off, we will return or increase that distribution to our investors. And when I say payoff, it's not necessarily getting the loan repaid, but if there's any additional upside within that particular loan, like for example, a profits interest or penny warrants within the operator, and we're able to pass that along as required by law to our investors. And because we're taxed as a REIT, there is an additional benefit on the taxation side. So on these above market distributions, you're only paying taxes at the federal level on 80% of those. So that takes your taxable equivalent yield even higher than what the numbers that you see on the screen. So if you look on the left-hand side, I put out a hypothetical distribution rate of 10%, meaning that you would need to go out and find a taxable investment that's generating 11.2%, pay the taxes to get equal to what we're paying in MJ REIT at 10%. And by the way, as I mentioned, we've been higher than that 10% every month since inception. From a growth perspective, going back to inception, if you were to have put $100,000 into the portfolio, that 100,000 today would be almost approaching 135,000. Our latest distribution, which we just recently paid for the month of May, came in at 10.75%. Our annualized since inception return, which is on the top of the right-hand side, comes in at 11.29%. That is annualized since inception net of fees and expenses. And importantly, all the distributions that we distribute, there's no return of capital in that. Those distributions are a result of the interest that we're earning off of the loans that we make. And furthermore, as we look to mitigate that risk, I have zero leverage inside of the fund today. And that gets back to this scarcity of capital and our ability to earn above market returns for investors without taking that additional risk of employing leverage inside of the fund just to juice up the returns. And I would tell you that if you look at Blackstone's REIT or FS's REIT, those REITs tend to be levered anywhere from 2 to 3 to 1, meaning that if you raise $1 million, you have $4 million of assets because 3 million is in leverage. So at MJ REIT, we have zero leverage in the portfolio and all of our distributions are fully covered. So when I started the strategy, I wanted to partner with a firm that had a unique background and deep bench of analyzing and allocating to private real estate within the United States. Gould Investors, and specifically if you look to the circles or chart on the right-hand side in green, Rainbow Realty Group. Rainbow is the sub-manager on MJ REIT. So Rainbow has the responsibility of diligencing and finding opportunities in the marketplace for MJ REIT and inclusion inside of the fund. Gould Investors, for their part, which is the parent, Gould is run by a real estate family out of New York. They've been investing in real estate for 64 years. They manage two publicly traded non-cannabis REITs that are traded on the New York Stock Exchange. And they saw the opportunity in 2016 within the cannabis space, given those dynamics that I outlined, and the fact that you can't go to a bank and get a loan or get a mortgage on your property. So this to them was an area that they would be able to generate better risk-adjusted returns for investors. And they've been a fantastic partner for MJ REIT on the diligence side with their time-tested methodology of going through and finding very risk mitigated investments to put inside of the portfolio. From a deal side and from an approval side, they have a 7-member investment committee where if you looked at the real estate experience of those 7 individuals, it's exceeded 200 years of experience within the commercial real estate market, focused on structuring, so deal origination, on the legal side, accounting, finance. All of that is focused within the broader real estate sector. So very deep bench with a tremendous amount of experience analyzing and ultimately allocating to deals. If you look at the selectivity, and this gets back to the idea that there's a high amount of demand for capital. So it's not hard for us to find deals, but it's always challenging to find good deals. And so given that high demand and lack of available capital, we can be extremely selective in the deals that we allocate to. And so from every 100 deals that we look at, most of those deals won't even pass the first cut. They'll be thrown out. That takes you down to 30. It's whittled down to 9, 3, and then ultimately 1 to 2 deals. So we close about 2 to 3% of the deals that we initially look at in any given year. And so we could fund them all, but we choose not to because they don't fit our risk parameters ultimately inside of the fund that we're looking for to help mitigate that downside protection. For a deal to get into the portfolio, it's important to have a large funnel to where we're seeing every deal in the marketplace. So we see deals from current relationships that we have. We have a network of brokers. We'll participate with other lenders. Of course, from a lawyer or an accountant standpoint, we get deals sent to us, the general brand and the marketplace, repeat borrowers, and then ultimately company consultants. So we have all these different funnels that are feeding us deals, ultimately so we can continue to be very selective. We want to put inside of the portfolio deals that we ultimately believe, because we're fixed income focused, are going to pay us back at maturity and be able to meet their interest obligation along the way. So we're not buying a piece of equity that's going to go two or 3x. So we have to be very focused on risk mitigation and ensuring downside protection in every deal that we do. Most of those deals, as they pass this process and deal sourcing slide, will fall out. There is a lot of different steps, a lot of different reviews that go into it, with the point being that for those 1 to 2% of the deals that make it all the way, we will fund those deals and close. The deals are episodic, meaning that we don't close a deal every day, every week, or maybe even every month, but we have a large funnel, so we're constantly reviewing those deals, and maybe it takes a couple months for that deal to close. But I'd rather sit on cash than allocate to a deal that doesn't fit our parameter. And so that's exactly what we'll do. We'll make sure we get into those good deals to help mitigate the risk associated with investing. This is probably, if I had to pinpoint one slide within the presentation that is most important to what we do, it's going to be this slide. When we go out and this is critical to how we analyze every property. When we value a property, we assume that cannabis goes away, and then I need to replace that cannabis tenant with a non-cannabis tenant. So let's say I get together with two friends and the three of us go out and we apply to the state of California for a license to cultivate cannabis. We identify an industrial property. We look at that industrial property. We buy that property for $2 million. It's not out of the question that we may need to put an additional 6 million into that property to outfit that building for HVAC, high-tech security, irrigation, lighting. And when you look at that, we bought it for two, we put 6 million into it. So in our mind, that building's worth $8 million. And to a cannabis operator, that building probably is worth something close to $8 million. But what if I had to replace that cannabis tenant with a non-cannabis tenant? Would the non-cannabis standard industrial tenant need 15 air conditioners and state-of-the-art security? Or even would they be willing to pay for that? No, they don't need it. So why would they pay for it? Their valuation would probably be closer to that two or maybe 2.25 million valuation point. So when we come in and finance a deal, we don't finance it for $8 million because we know the non-cannabis tenant that I need to put into that building won't need that 6 million of improvements. And so we would come in at a 2 or a 2.25 million in valuation and then underwrite a short term, 2 to 4 years in nature, senior mortgage at up to about 75% LTV on the lower valuation. So think about the numbers in this particular example. So we have a building on the cannabis side that's worth $8 million. We have a building that is on the non-cannabis side worth $2 million. And our exposure is a senior mortgage that might be 3 years in nature for 1.5 million. So if we need to come in and foreclose on that property, the ability for us to find a suitable tenant to take that property over, we can do so very quickly. And we're not beholden to finding specifically a cannabis tenant. We could potentially find a non-cannabis tenant. In practice, it would be better for us to just bring in a new tenant and they click day one and continue to grow cannabis because it's already outfitted. But if we needed to step in and remove that 6 million of improvements, although we certainly won't get 6 million on the aftermarket for those improvements, maybe we get 500,000. And that's just additional upside for our investors. And if you think about really what I've gone through here and boil it down, it's very frankly, very succinctly that our investors get compensated for the risk of cannabis without actually taking that risk. And I say that because you would be taking that risk if we financed at $8 million, but you're not because we financed it at the standard industrial going rate. And that's critical to every deal that we get into and every deal that's been put inside of the portfolio. Since we started back in 2022, we've financed 31 deals across 8 states. 3 of those deals have paid off. And if you recall, when I showed the monthly distributions, and 3 of those months were standout months with 15+% distributions, this is why they were so big. We financed in late 2022 5 properties in the state of Ohio before Ohio moved to recreational cannabis. Once that transition occurs, the demand for cannabis real estate skyrockets. And that's what occurred to these 3 properties that sold. One sold in March, one sold in May, and one sold in October of last year. Those generated anywhere between a 33% IRR and, or I should say 31% IRR and up to 65% IRR. So because we're taxed as a REIT, we get additional income into the fund, and then we're required to pay that distribution to our investors. And as a result, in those months, March, May, and October of last year, our distributions increased to in excess of 15%. So anytime that we get the ability to distribute more capital, we will do so that our investors have a more favorable and better risk-adjusted return than without. From a deal pipeline standpoint, we will look and talk to anybody in the marketplace. Currently, we have over $90 million of deals that are going through our diligence process, and we can continue to be extremely selective in those deals. For example, in 2024, we looked at and valued over $200 million worth of deals, but chose to only allocate to 17 million of that total deal flow. We have a few properties that we closed on over the last 60 days, and we have two more that are set to close over the next 45 to 60 days. And again, there might be a situation where we get close to that closing date. There's a signature missing or something happens and it gets pushed a week or two, but ultimately we're going down the process of closing on these additional deals. And specific to these deals, the two on the right-hand side were the two that we recently funded. The top right was to a company called Verano. They are a top five multi-state operator. On their part, they have a deep balance sheet, and this is two of their crown jewel assets, located in Arizona, one located in Nevada. And then the two on the right-hand side are potential deals that we're looking to. And you'll see in some instances, some rates might be a little bit lower, some might be a little bit higher. Ultimately, what we tend to look for is the risk mitigation factor. And if we can have a lower LTV or loan to value, or there's a personal guarantee and a corporate guarantee included, we, to win the deal, might offer a rate a little bit closer to traditional lending standards. So the top, we're looking at a 13% deal on the bottom. I'm sorry, at the top left. On the bottom left, the interest rate on that is at 16.5%. Point being, we have a robust funnel, and we will look at and analyze any deal that comes our way, because we want that broad funnel so that we can have the best possible lowest risk deals inside of the portfolio for our investors. And how do we generally exit deals in the portfolio? There's really four ways that we'll exit the deal. As you saw, the payoffs that I mentioned earlier, the first way is that the building is sold. And with that sale, the mortgage gets retired and we get our capital back. And then we recycle that and we go out and we find another deal to allocate to. The second is, let's say I make a loan and 2 years later, rates come down and the borrower can refinance that at a lower rate with a different lender. And we get taken out in that refinance. Generally speaking, when we originate a senior mortgage, we may have a no call, meaning that the borrower can't pay it off in year one. If the borrower pays it off in year two, there's a 3% prepayment. In year three, it might be 2%. In year one, it might be a 1%. Any of those additional fees that are earned go into the fund as additional distributions to our investors. So that's another way that we could get refinanced out or get the loan paid off. A third and fourth, less likely, but still an option, is that the borrower generates enough free cash flow to pay us off at closing, or there's a private equity transaction, and in that transaction, the private equity firm is looking to reduce debt on the balance sheet, and as a part of that transaction, we get paid off. So those are the four general ways, with ways 1 and 2 being the more prominent or more likely way that we get paid off. From a involvement standpoint, just wanted to show a quick review of, and this isn't the entire team, but of the team that's involved on a day-to-day basis. On the left-hand side, I'll start with me. You know me from the CEO and founder. My partner, Gopa Dobson, takes care of our distribution and marketing. Kyle, who is the CEO of our sub-manager, Rainbow Realty Group. Matt Gould is the CIO, and Ben Balanis is the COO of Rainbow. And we're constantly in the market looking for deals and constantly looking to continue to manage the portfolio in the best, prudent, and lowest risk way possible. So really what makes us unique, and I look at the three, I'll throw the term out, the three uniques. We are an institutional real estate lender. The cannabis real estate space is not a space to get into half. You have to know the space because every one of those 41 states that has a program has a different set of rules and a different set of regulations. So you need to have a deep bench and knowledge in not only the cannabis and not only the real estate, but the regulations within each one of those underlying states. And this is all we do. We focus exclusively on real estate within the cannabis sector. We're not lending to operators and we're not buying multifamily value add positions in this portfolio. We've done this before, and I mentioned currently we have 28 properties. We've done 31 since inception, three of those paying off, leaving 28 properties in the portfolio, and those properties are spread across 8 states. So you get not only diversification on the geographic side, but also from a property standpoint, we continue to increase that diversification with 2 additional states likely to come on over the next 60 days. And the last on the right-hand side is we dislike downside risk. We are debt managers at our heart, and we will do everything we can because we don't want to lose a single dollar of capital because we're not in an equity position where we can do 2 or 3 or 5 times our money and make up that small loss. So we want to be methodical on the deployment of capital, ultimately to increase the ability for us to get repaid at maturity, collect that interest along the way, and then recycle that capital into additional deals in the market. So institutional lender, very 100% focused on the cannabis real estate side, that we've done this before and we have a diversified portfolio and the risk mitigation factor. So those are the three kind of components that make us unique. And if you look at our investor base, there's a few reasons why we get included into a portfolio for investors. I'll just say from a high level standpoint, it really is as you think about your broader diversification in your portfolio, you might have exposure to multifamily, maybe mobile home parks. Well, we fit nicely in that segment where we'll help diversify your real estate exposure within your investment portfolio. Additionally, maybe you're looking for stability and enhancement of income. We fit nice as a fixed income alternative because of the high above market income that we're consistently paying on a monthly basis. So most investors, if you look at the page overall, allocate to us for consistent double-digit returns. They're looking to diversify their portfolio. And maybe quite frankly, maybe you're fed up with the enhanced volatility that we've seen in the marketplace. I will reiterate again that if you look at the first and second quarters of 2025, and really going back since inception, we've had zero volatility in the portfolio. Meanwhile, you've had enhanced volatility in the public stock and bond market. And last is the ability to enhance the distributions due to our tax filing status. So investors, again, going back, get a tax advantage component when paying taxes on the distribution. It was very important to me, governance, when I set up the fund. I wanted an independent board of directors. So I chair the board. My partner at Rainbow, Matt Gould, who's the CIO, sits on the board. Michelle Gillespie, for her part, she is an independent board member. She's very involved in the diligence within the private placement space. She started her own firm. She comes with over 2 decades of experience. Matt Malone, I've known for almost 12 years now. Matt is the president at Opto Investments, Joe Lonsdale company. And then Jeff Mylock is independent board member as well, focused really on the private equity side. So 3 of the 5 board members are independent, making us an independent organization. I'll conclude with this slide just as a summary before opening it up for questions. You think about why should you consider MJ Reed and why now? First is that we take an institutional approach to a timely opportunity. Investing in cannabis and earning outsized returns will not be around forever. That's why we offer monthly liquidity inside of the portfolio. So maybe you say, okay, Chris, I like this opportunity. I'm going to allocate 2% of my investments inside of or to MJ REIT. 18 months, 2 years later, you see a better opportunity. You simply tender your shares, you take the capital back and allocate to a different portfolio. So there's no lengthy lockup and you're taking advantage of a timely opportunity because as banks get into the space and 5 or 7 years from now, I'm not going to be able to put money into the market at 14 or 15%, but rather we'll have to put that in at 9 or 10% at lower rates based on what the current industry average is. So you're able to earn these outsized returns. And again, this is not a forever strategy. This is a strategy that ultimately will be in place for the next 5 to 10 years. And as competition comes in, rates will go down. 1099, I can't state this enough. The simplicity for reporting taxes was important to me when I designed the strategy, and I suspect it's important to you when you're filing your taxes. I mentioned the no lengthy lockups. And for those that are looking to allocate, I wanted to make this strategy low on the investment side and not have a seven-figure check that you need to write to get access to this area of the market. So our minimum is only at $25,000. We do price the fund on a monthly basis. We admit investors once per month. So at the beginning of every month, we'll have new investors come into the portfolio and begin to earn that distribution day one. So you're not waiting for 60 days or 90 days to begin to earn, and then you get paid that distribution on a monthly basis. And we endeavor to pay and have since inception the distribution by the 15th following month end. So those are general terms of the strategy, and that's really the summary that I wanted to provide from a high level standpoint. And at this point, let me just take a second and look at the Q&A and see what questions that we have that have come in. All right. All right. From a question standpoint, it looks like John here has a question specific to the monthly distributions. Can you reinvest those in additional shares? It's a good question. I forgot to answer that earlier. Because we pay those monthly distributions and because those distributions are so high, you do have the ability to reinvest those distributions into additional shares. In fact, about 70, almost 75% of our investors take advantage of the dividend reinvestment program. The main reason, probably two, is that they don't actually need that income. And if you do choose to participate in that reinvestment program, you get a 1% discount. So instead of reinvesting your distribution at 100% of the net asset value, you come in at 99% of net asset value, which gives you an additional bump in your total return. So John, thank you for that question. And it looks as though, let's wait another second and see if we have any other questions that are coming in. Okay, we have one more. Is this available in a qualified or IRA account? We do have the ability. Our investor base, we have about 20% of our investors that utilize the strategy through their self-directed IRA. We have relationships with most self-directed IRA platforms in the marketplace. So you can hold us through your self-directed IRA, or of course, you could come in on the taxable side as well. So I appreciate that question. Okay. Doesn't look like I have any more questions at this point. So let me just finish by saying I appreciate the time today. I'm just showing on the screen some of the particulars, the $25,000 minimum, management fee at 1.5, incentive fee at 15. On behalf of myself and everybody at the organization, I just wanted to say thanks for taking the time. I truly know that time is the most valuable asset that you have. And so for you to spend some time today with us on this holiday, we truly appreciate it. On behalf of myself and everybody at the organization and our affiliates, we thank you for your time. We will follow up with a replay of this video. And if there are any questions that come up along the way, please feel free to reach out to us directly. And you can visit us online at mj-reit.com. Thank you very much for your time, and I hope you have a great day.